Okay, it's starting now. Right. So we got this Australian Canadian dollar. And now we got, we need to actually, all we need to do, you need to actually find the trade. So I'm actually removing all these indicators and everything. You got a blank chart, and one of you guys actually have to tell me how we can start on this. Okay. There you go. Who can do it? Our goal here, this is a 4-hour chart. Our goal here, we want to have a trade which will last at least 3 days. Who want to help?
First, we look at the trend.
Sorry?
Let's check the trend first.
Trend first?
Yeah.
Okay. We got 1 year back. What's the trend says? Trend is?
Sideways. It's got support and resistance.
Okay, that's my trend. That's my last high and low, which break right up here. Okay, I also want to tell you something that's, I want to draw my resistance around here. I can see this area is a bit congested. And I also see something else. I can see up here, price is bouncing back, right? So now if I go to the closer, that's the picture I got. Anyone? Come on. This is very easy trade.
So there is a doji. Doji, the red doji. Then you go with the long
First phase, first
reversal.
section into the trade. Right. Buy time. Why buy time? You see, it's a trending market. First of all, tell me, it's a trending market, is a trading market? Is it sideways or is it trend base? It's going sideways for now. Yes, that's right. Which indicator will help us to enter into the sideways market? Stochastic. So let's put that one in. Oh, that's gone. You can see it's gone up. You can't buy here. Yes. Okay. So you can see that we got this support. Price is coming down. Based on this stochastic indicator, our entry point was here. We missed out the entry point, and the prices actually have moved up a lot because now it's on the overbought, this is oversold, overbought zone. If you buy on the overbought zone, the prices may revert back. And I can already see this happening. So you can see this is little support here. Sorry, a little resistance here developing. So I don't think so I will enter in this stage right now because my stochastic is telling me is on oversold, overbought condition. In the sideway market, I only rely on the stochastic and my support and resistance to tell me if they confirm each other. That's the only time I would enter into the trade. So
after the doji, the last.
Hang on. Your voice is very low. Can you speak up a little bit? Yep.
So if you look at the doji, the last red one.
This doji.
Yeah, this doji.
Yeah.
So then
yeah, if I would have looked at this doji, then in this bar I would have entered into the market. This market is not. This bar is too late. You look at here. This support here, that's telling me into the market here. And you also need to remember what is the characteristics of the doji when if they are in the swing point or not. So 2 to the left, 2 to the right. You got a doji here as well. You got a doji. This is the valid doji because you got 2 to the left is down and 2 to the right is down. So that's the valid doji. This doji is got 2 to the right up, but at the left they all together. They all in the same place. So doji only have a significance if it stands out. Okay, so I took the screenshot here. I'll put my comments and we will check tomorrow what's happened. Okay, so USD JPY. Now this is super easy on the 4-hour chart for tomorrow. Buy, it's uptrend. It is uptrend, but what's your position? So you can see here, you are on the second phase right now, and you need to wait for the phase 1 of the next cycle, right? No, not wait for the next bar, wait for the next phase of the cycle. So from here, you wait at least 1 bar. It will confirm that yes, you are going into the next cycle. Then you put your entry around that mark here. So you see, this is a kind of your analysis for the next week, what we are doing right here. I'll take the screenshot of this, and I also put this one in our comments.
Sir, I have a question.
Yes.
Hello. Can you show us the MACD at this moment and see how the MACD is actually supporting that we should be going buy on this?
There you go, the MACD. Yep.
Can you explain MACD on this chart a little bit more, please? I have some confusion regarding this signal line and
okay, I will go.
When to buy and when to sell.
Yes. Tell me now, what do you want to do? Hello?
I will not buy. I will not buy.
You will not buy. It's a good signal. You will have a buy signal sometime next week. Very, very easy. Yes, I can see the divergence here. This is going up and this is going down, but this is something which you need to watch. So if you wouldn't have seen this MACD divergence, and if you actually seen this one, you might have buy on the next bar, isn't it?
But the next phase one.
Sorry?
Phase one of the cycle. Next phase one of the cycle.
Yes. This is actually phase 2 of the cycle. So we need to wait for the next phase of the next cycle. But again, even let's say the next phase is says I think I can't write here. So if next phase actually goes up this way, 1 or 2 bar, your MACD is telling you this is going down. Isn't it confusing? Now, or just to add your confusion, let's do one more thing, very, very easy. Okay, what is the characteristics of an uptrend? Higher high, higher low. So this high should be higher than this if it is going to the uptrend, which it is, right? Now this low should be lower than this, which is right. High, sorry, this low higher than this, which is right now it's happening. Okay, so this is how actually you can see. If you can see that yes, MACD is giving you divergence and those one, you see if the price is actually touching somewhere at the top.
But if you look at the last candle, is that the reversal candle? Because it's like it's not the hammer, the opposite of the hammer.
This is not the hammer. Okay, so if I remove those lines, these are not the hammer.
No, the last one. It's the one that reversal candle or like the
Yeah,
one
no,
that
it's
goes up
not.
afterwards.
It's not. Tell me which one you're talking about. This one?
Yeah, the last red candle. Yes.
This one?
Yes.
How you can say it's a reversal candle? Where is the selling pressure on this candle? Or buying pressure? What kind of pressure you have? So you can see the price is trying to push up, but the buyer actually failed and the prices is actually come down. So they close here. They open here, they close here. So the closing of the price on yesterday or when it's closed, it was around this mark. This is the one. It means that buyer were trying to push the price is higher. They could not succeed that one. What I can see from this candle and the previous candle, that the market will actually go in a sideways for about another 1 or 2 bars or 1 or 2 days or maybe because, and the reason why is that if you look at around that one, you see how they are almost touching the same point, and you look up here, they're almost touching the same point. So my feeling is that the price is actually move between this congested area and then it will go up again. So we will actually wait, and if the price is on the congested area, it means that the price, the cycle, this phase 2 of the cycle may have end, but the next phase hasn't started yet. So you have to wait for that next phase. But this is actually very, very good trade for the next week, I can tell you. There's 2-3 time bodies. Okay. Make sense? So we delete that, and I will take the screenshot of this, and I'll put my comments, and then we will watch next week's how they plays. Right. So you see, we already got one pair for next week to play, right? USD JPY on 4-hour time frame, the time of the trade when the European market starts, not during the Australian, maybe Asian session, yes, but I wouldn't play much on that. Okay, so we see on this particular chart that the trend is up. We can see that the phase 2 is almost finished, and we're waiting for the phase 1. Now let's try to find some other indicator which can actually help us to tell us like, yes, it's a confluence of their confluences, and they can, we will try to get some confirmation from moving average, right? We add the moving average, 30, I think that will react to 50. So 50 moving average. There you go. It's coming closer to the 50 moving average as well. Like you can see here, that's your trend line and the moving average coming together, and the same time you start your next move. So I'm actually feeling that's here you can see that's your trend line, that's your moving average. They're very close to each other, maybe 1 or 2 bar more, and then it will go up. So it's not a buy signal just yet. We need to wait for the next cycle of the phase 1 of the next cycle. We will ignore MACD. Yes, we ignore MACD at this stage. We don't need to worry about the MACD. The MACD we only check. We see a little bit alarm here that it's a divergence, and the price is moving up, the MACD moving down. So we get this alert from the MACD, but we will not actually take the MACD in. I mean, we could consider MACD at this stage. We just see that, yes, if it's a divergence happening, then we are a little bit cautious here, because I got a suspicion that prices may come down a little and then go up. Right. So we find out one trade for next week. Let's look another one. So first of all, what we can do, we can actually simply just go to those news items. We're looking only the important news item for the next week. So from 4th until 9th. Okay, so we got Monday, the Great British Pound Service MPI. What this is. Actual is more than forecast, good for the currency. So we got, you can see here for the last few months, it's actually coming, this is more than actual, more than actual, more than actual, and then is equal, and then less than actual forecast. So I got a feeling that this particular curve, this one, it may play a little bit, but I got a feeling that this the news already, I mean, they discounted in the prices. So there's nothing much up there to wait for that one. The only thing what you need to worry about is like Australian dollar cash rate, everybody knows that it's not going to move. So it's already considered in the prices, and the prices already accommodate that news. So it's not important anymore. Canadian trade balance, yes, that's very important, because we don't know that's what will be. So interest rate normally, you know, but these kind of figures you don't know. So actual more than forecast, good for the currency. So last time in previous was -4, forecast is $2.1 billion, and that's the news coming on Wednesday. The trade balance news on Wednesday with Canadian dollar will have an impact with the USD and Canadian dollar. The reason is the Canadian dollar is a net exporter of oil to the USA, and Canada buy lots of goods from USA back. So that's very, very important to watch. And if the Canadian, if it actually goes other way around, like the forecast is minus 2.1, and if it goes higher, then you will see that this pair USD and Canadian dollar, it will be in imbalance, and then there will be a time to check on that. Crude oil inventory. So I will actually just focus up here on this area. Tuesday and Wednesday, we will see the other one when the time comes. So Tuesday and Wednesday, Canadian dollar to watch, and the Euro Italian constitutional referendum. Yes, that's very important, which I think is already happening today. So it won't have any impact on Monday when the market will open, because Australian time or the Asian market when open, it's already discounted for that result. When the Europe market open, we won't see much movement or much impact on the euro. So yes, the only thing is if we want to monitor is pound and the Canadian dollar for the next week. Now, based on that, let's check the currencies with the Canadian dollar. Australia, Canada, or US Canadian dollar, right? Okay, here we can see that's USD and Canadian dollar. So Canadian dollar is a strong, USD is weak. And what's the overall trend? Overall trend is actually a sideways market, right? The moving average is in between the pricing, and the short-term trend, we can see it's going a kind of sideways from here up to here. So there is nothing much we can do on this one unless we want to monitor. We just keep watching on this. There is no clear-cut trade on this pair. But the one which we've seen, that's the USD. Yeah, that's the one. USD JPY is very clear tomorrow for the next week. And also Canadian and Swiss franc.
So when you look for the news like US, Japanese yen and US dollar, do you look at Canada and Italy news as well, or just Japan and USA news?
No, the news which I'm considering is Canadian and British pound. That's what I can see are the important news for the next week. The Italian constitutional referendum, that's happening today. So in the Asian market, the euro will be volatile, and the prices movement or whatever the result of this, the constitution, it would have already been discounted in the price. So we not much worried about the euro during the London session. So the Australian dollar, we know that the cash rate is not going to change. So it's already
the currency.
Sorry.
My question was that if we are interested in Japanese yen and US dollar trade next week, will we only be considering the news regarding US and Japan, or we look at other country news as well to avoid?
No, you can. I'm using actually all the currencies for next week news, and I can see which I think it's an important. So what I can see, that Australian cash rate is very important. But because everybody knows that the cash rate is not going to change next week. So it means that it won't have any impact on the price. So I will discount that news altogether. British pound service PMI. So that is an important, but what I can see for last 3 quarters or last 3 months, they are almost actually coming more than forecast. So what I can see that if it goes other way around, then it will have a big impact. Otherwise it won't have any impact. The same thing with the Canadian trade balance. Trade balance is something which you don't know upfront, and the forecast sometimes is not accurate. If you look at the history, you can see that none of the forecasts, they are actually true. So November, they were thinking 1.7, it was 4.1. Then in October, it was 2.5, they said now 1.9. So I'm actually waiting for this particular, the news item, the trade balance, and after the trade balance, I can see that the currency which pair with the Canadian dollar will have some movement or some volatility to make some money. That's how I'm looking the news. It's got nothing to do with the currency pair which I'm looking currently, JPY, USD. I pick up the USD JPY because I can see it's very strong trend on that. Okay. So this is another one, Canadian dollar and Swiss franc. So you can see this is also is touching almost up here at the top, and the price is actually going into the congested mode. When I say congested mode, means that the bar are smaller and they are very close to it. So it means there is not much volatility in the market on this particular currency pair. What's your thoughts on this one? Are you going to buy, are you going to sell, or what you're going to do?
We've got a doji at the end, so we don't know if it's out. I'll probably wait now.
But what's your expectation? We will wait, but what's your expectation?
It may become.
Let me ask a simple question. If it is not, if it was not doji, will you trade this pair?
It's in the up phase of the cycle, but I think we have missed the point.
We missed the point. Yeah.
It's in the upswing of the cycle, but we haven't started at the phase one. I think we are
right now. So, okay, someone says two things here. So. It seems that upward trend overall. It may become a sideways trend. We'll wait and see. Okay, so Abdul Qadir says we wait and see, and he says it's becoming a sideways trend. Can you explain why it's becoming a sideways trend?
It's because of the last is not the lower low and or high is not actually that. Sorry, the higher high and the.
Yes.
It's not.
You are 100% right, and you can see here that the prices are actually is touching the last highs, and here is actually almost all those bars are touching the same one. So he's right that the prices are actually in a squeeze mode, in the sideways mode. But what I can see that if the prices will break out, which way will it break out?
the breakout will likely to be up.
Likely to the up, right? Only if this become positive. The last one was November 4. Did you see this gap here? That's exactly what's happened. Canadian dollar last November. Okay, so all we need to do, we need to basically, the pointer here is that we actually wait and see if this news up here, and when it's coming on Wednesday 7th, that's Australian time. If this news is like I would say it's very bad, then maybe we can see that the Canadian dollar is dropped down. Otherwise, it will break out. But it definitely is going to break out next week. Okay. So I'll take the screenshot of this. Now, Euro Canadian dollar. What's happening? Sideways. Okay, so let's see if it's sideways. Yeah, it's sideways. What's the difference between up and down? 135 pips. Is it a tradable? So if it's the sideway market, then which indicator we will use? Little volatility, difficult. Well, volatility is quite high. We can see the difference between these two is 135 pip, right? So I don't think so that's the volatility as an issue. So let's put stochastic. Now, there is no trade. We actually, when we use the stochastic, either we buy around this point and we sell this point. If it's in the between, we ignore it. Even though that some people can say like, oh, even at least in one bar, I can make maybe 30, 50 pips. Yeah, you can, but that's a risky. Euro pound.
Sir, I just have one comment. When you are actually moving the cursor, the screen, when it is like when we receive, there's a lag between the what you speak and what we see. So can you just do a little bit slower?
Okay, all right.
Only
No.
these times when you
Sure,
show something.
It's a little bit lagging, yes, I know.
We end up actually getting the wrong.
Which currency we were looking before? Euro Canadian. This one? Yep. So what I was telling on this screen is the prices, because we consider this one as a sideway market, right? Then we will use, if it's a sideway market, we will try to use the stochastic for our entry and our exit. Our entry is normally when the prices goes below 220 and come back above, cross above. So here is actually touching and coming back. So that would be our entry point. But then after that, it's just going into the sideways, not going up or down. So it's not a good pair at the moment to trade. So now I was going into Euro Canadian dollar. Sorry, British pound and Canadian. Okay. So I will remove all those lines so we can see what's happening. Right. What's happening? It's again sideway market. Right? And it's touching at the top of the bar, top of the resistance. So we put the stochastic and see if we can get any sell signal here. Yes. Sideway, waited for if it is breakout. Right, so Nasser says we're gonna wait, and if it's breakout, then we enter into the market. Yes, this is one of the strategy you can use. Because it's a sideway market and I don't know when the breakout happen, I will use a different strategy. I will use to this one to start a next cycle downwards, and then my entry around that mark. This will be my entry somewhere if it goes down. up here. Right, that will be my entry. That will be my entry, and I will also wait if at this entry coincide with this the stochastic turning down below the 80. Right, so I will wait for this one to turn down this way, and the price is, if it's a breakout, that's fine, we'll go upwards, and I don't think so you can go any higher than this. This is the high point at this stage. Yep, or another one will be that one. So we will wait for the prices to cycle through and let it go up and down. Then on the next cycle, I will buy here. So I won't put my order right now. I will wait until it's come down, then I will put my sell order and sell it here. Even if it doesn't move that far, and if it's moved only right up here, which was the last few times, it's still, I should be able to make about 15, 20 here. So it's about up here, 130 pips. So that will be a quite good trade next week, especially with the two news coming, Canadian dollar and British pound. So okay, now that's done enough for those analysis. Let's go back to our the training. And so stochastic we done, the MACD we done, moving average we done, and this is one of the the signal from the stochastic. But when the price is touching support, stochastic is in oversold condition and turning back and about 20% line. Place your order few pip above on the bear legs last bar. Exit when touches your resistance. So it's the same thing, which scalp only between when the spread between the support and resistance is more than 15 pip. If it's less than 15 pip, do not trade, use this technique at all. This is some of the examples which we already went through, so we don't need to go through here. As you can see, this moving here, that's touching the support. That's your exit point because it's actually coming down through the 80. So that's kind of the example we went through in those some live analysis. Now it's come for the money management. Let's put it that way. That's if your starting capital is $10,000 and if you make 7.5% gain, which will allow you to make $750. And if you lose 2.5%, that will be your $250. So what will be your net gain? You place a 15 trades per month. You got 4 winning trades, 1 each week, with 7.5%, which is a 30% all over the month, right? So you got 4 winning trade with a 7.5%, right? Then you have 10 losing trade, 4 at the 10%, 4 at the 5%, 2 at 1.25. So all up you're losing 16.25%, and out of 16.25, that's your losing, 30% is your winning. So if you see, you still net ahead on this one. The thing what I'm trying to tell you, that if you have your money management rule defined very well and you follow those money management rules, then you may have a more losing trade, but the losing trade don't have to be actually a big losing trade. And normally people actually have the big losing trade because they wish that, oh yeah, it will come back, I will wait. No, if it has touched your stop loss, that's it, end of the story, move on. You define your stop loss and the take profit upfront and let it happen whichever way it goes through. If it's hitting more your stop losses and not on your winning take profit, then you review your strategy. You don't try to muck around with the trade. If you try to manipulate your trade against your rule and you say like, okay, this is actually going down, but I wish it will come back. Maybe I will wait a few more weeks, it will come back. No, we're not going to do that way. We very, very strict with our stop loss and the take profit. If our stop loss says that your stop loss is a 10%, it's a 10%. That's it. We don't allow to go down anymore, just in a hope that it will come back. So hope have no play in the trading. They all should be the logical and the rule-based trading. So if your stop loss is not working, then you have to review your stop loss strategy, not your trade. This is almost the same. Now, many people, I ask this question, and many people sometimes they answer a little bit wrong, incorrectly. So you got box A and you got a box B. Box A, if you choose box A, you will gain 500, and if you choose box 2, you gain 1,000 or nothing. Then I got this another one. That's if you choose box A, then you lost 500, and if you choose box B, then you lose 1,000 or nothing. Normally people say I will go for box B, but I would say that's again, it is against your own trading rules. So the box A is the right answer because you got your defined losses. Same in your gain, you just get box A because you got your defined losses, that's your defined gain. Both time the box B, you actually don't have anything defined. So you go for something which is definite. The one of the thing that's cut your losses and let your profit run. How do we do that? The way we do it is, for example, if I go in this trade, and let's say go to which one we're using, it's very strong, USD JPY, right? So let's say I'm on the USD JPY. At this place, I put the 3 orders. One order is this is a 3 separate order, not the 3 lots, right? So you order 1 order, 2 order, and 3 orders. So 3 orders. So you enter the 3 orders here. You exit your first order when you actually reach your about maybe 10 or 15% of your target. You exit on that order. The next order you exit when you reach another 50% of your target. You move your stop losses up and let the third trade run as much as it can. So there is no take profit on the third lot, but you do have a take profit on the first and the second lot. As you move from the first, if you exit your first lot, you move your stop loss to the first lot's entry point. Sorry, the first lot's take profit. That's now reduce your risk. When you exit your second lot, you move your stop loss to the exit of the second lot and let the third lot run as much as it can. Because now you already cut your losses. So all you can lose is you can lose a little bit of your profit, but let your profit run. So let's say just put up something here. So I got, this is my 1, 2, and 3 orders. My stop loss is somewhere around here. That's my stop loss, right? This is my first exit. It means that this order is gone. So this order is now gone. I move my stop loss. It's right up here, right? So I remove my loss, all my loss are gone. My second one is actually exit around here. And the third one, it doesn't have any take profit, it can go as much as it can. But as I actually take this trade out from here, I will move my stop loss back up here, right? If this trade now goes against me, the maximum it can do, it can hit here, and then I'm actually still I make some profit on this one. So that's how I do the trade. I put 3 order at any single time. 3 order doesn't mean that you are going to put the 3 lots. If you don't have enough capital, then you can't put the 3 lot. So what we do, we actually put the order. You see here it says volume. We just simply change to 0.25. And that's my volume of my 1 lot. So if you got a 3 lot, then you're still trading 1 lot. but you are breaking up your one lot into the three. And that three will allow you, this three different order will allow you to manipulate your stop loss and your take profit quite easily. Or you can even do the 33%, let's say 33%, right? Yeah. So that's how. So because many people actually say, okay, if I put in a one lot, if I put an order of the one lot, then how are you gonna take part of them and close part of the position? So you can't do that. You actually have to put the three order with the 0.33 lot size. Okay, so is any question on the stop, this take profits, or sorry, this lot sizing?
So it's not like like shares you share part of your shares and let the run the next one. So it's you have to divide your order into the diffs. So is that correct?
Yes. In the share market, what you can do in the share market, you can simply actually put the three orders with the number of the shares. Because I know that in share market also you can't actually, some broker will allow you to partly close your order. So if you actually purchase 1,000 share in one lot, they will allow you to sell, let's say, the 300 at any single time. The one of the very important thing about the trade management, match your expectation with the market reality. If your expectation and the market reality, they are not in sync, you will not make money. The reason why, because your ego and your thoughts telling you different and the market is doing something differently. So you have to make sure your expectation match the market reality. Market is always right. You and I we are not right. Okay, Nasir says that is there any automatic trailing stop loss? A bit at about, yeah, the trailing stop loss is there, but is a static kind of thing, so I don't use that. I lost my mouse. Hang on. Minimum risk to reward ratio is for stock market at least 1 to 3. If your stop loss at $1, your profit take profit should be $3. If you can see that your nearest support and resistance before $3, it means this is not a good trade. This is very important. People actually say, okay, my risk is 1%. Now I will take my profit at 3%. But you have to see, has the price is moving in the past to that level? If it is not, then you are not going to achieve your 3% take profit. And if you're not going to achieve 3% take profit, then what is going to happen? The prices will fall back and you will take your losses. So it's very important that even you get some signals, you use those signals, but you also monitor yourself visually and see that the prices are moving into the take profit target or not. If it's not, then it's not. It's not the right trade. These are the common mistakes you need to avoid at any cost. Never enter market order. Before entering the market order, consult your checklist. Never trade against the trend of the higher time frame. Never risk more than 2% of your total account at any single time. Now, the people actually misunderstood this particular concept. What I mean that's 2% of your account size is, let's say, for example, you got a trade open of one lot, which will cost you $1,000 to open the trade. But your stop loss should be not more than 2% of your account size. So if you got a 5,000 account and your stop loss will be probably, sorry, the 2% of your 5,000 is $100. So when you define your stop loss and take profit, make sure that stop loss, what you are targeting, is not more than $100. That's what does it mean by 2% of your total account size. If you already have an account open, sorry, if you have already a trade open with $50 stop loss target, stop loss, the next order you enter, it should only allow you $50 stop loss. It doesn't mean that you only trade 2% of your account. It means that you don't risk more than 2% of your account. Always check high impact news before entering. Do not change the swing trade into the scalp and vice versa. If you are in the 4-hour time frame zone, don't try to close your trade on the daily or 1 hour or 30 minutes or other way around. Because your trading plan, your checklist, you did everything your planning based on your 4-hour time frame, then just stick with that one. Don't change it. So well-defined money management rules are very, very important. So you do your homework every weekend, follow the checklist, don't trade on the fly. Don't use mobile phones for the trading. You only use the mobile phone for position watching and closing the position if it is going against you, nothing else. That's it. You can't have the visibility on your mobile phone the way you have the visibility on your computer. Screen size is too small. You don't have all those indicators and everything on the mobile phone. So the mobile apps is only for watching your positions and only for closing the positions, not for entering the trades. Maintain your log, especially those you have lose. So you have to actually write your log, and you have to make sure that those logs actually tell you what you are losing, why you are losing, why you enter in that trade, and what was your analysis. If possible, just attach a chart or something to that log as well. That log will help you in the future to overcome your mistakes you have done in the past. Develop your trading plan and trade as a trading plan. Education, keep learning, and your approach to market is very important. How do you see the market? Now it's coming to the stop loss. There are many ways to define the stop loss. The one of them is the support and resistance. People normally do put their stop loss few pips, 10 pips, 5 pips, or 8 pips below the support and resistance. Now, or some people actually use this 10 and 15 pip concept just near the moving average. Another one which I normally use is based on 8R, average true range. So we will discuss this one in more detail. But let me tell you something why I don't like the static stop loss. The currency pairs volatility are different. Each currency pair react differently. Their volatility, some currency pairs, they have high volatility and some have very low volatility. If you have same static rule for your stop loss below the few pips support line or up support resistance, then the currencies with the high volatility will hit your stop loss much quicker than the currencies which actually have very low volatility. The first one will kick you out of the market very quickly, and the other one will accumulate your stop loss for longer. The same is true with the moving average, few pip above or below of the moving average. The method which I actually see it's more workable is check the market volatility and define a percentage of the market volatility. And that's a personal preference. I normally, sometimes I use 30%, sometimes I use 50%. And I put my stop loss based on this 8 hours volatility, number of the pip which 8 hour will tell me, below the lowest support point. Okay, so I'm going to explain this 8 hour stop loss so you can understand what I mean. So for example, I have this USD and JPY, and I delete this indicator. I add an indicator here called ATAR, average true range. It's a 14 days period. What is telling me that for last 14 days, what is the average range of what the average range of that particular currency pair? For example, if I put my mouse, mouse here, here, it will tell me the ATAR is 0.584. Here is telling me is the same thing. And if you want to look at the last one, that will tell you here 0.561. After the 0.561, I will actually remove the last digit, which is 1, and leave the 56. So 56 or 5.6, whatever you can call it, is USD JPY. This one is my average true range, 56. If I'm using my technique in some of the currencies which are more volatile, I will use 50% of this 56. Some currency pair, I will use 30% of this 56. For example, in the 56, if I use the 50%, then it's mean my stop loss will be the nearest 25 or 12 pip below the nearest support line. So if I draw a trend line on this one, which goes something around that, and for example, if I'm entering a long here, then my stop loss based on this ATAR is 12 pip below here. So 12 pip is somewhere here, right? So 13.113.262, that's my stop loss. That will be my stop loss, 113.062, or I think a little bit up. Yeah, up here. This is a 4-hour chart. Now, based on the previous 14 bar, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 12 bars, or 14 bars, the volatility of this pair is only 56 pip on the 4-hour, 1 period basis. So that's now become my stop loss. And as I move every day or every hour or whenever I move, my pair is going up and up, I will check again my ATAR and I move my stop loss according to, for example, tomorrow the ATAR is coming back is 50 points, and the stock actually or the currency pair actually have moved up here, and this will become my support is coming here. So I will calculate again my stop loss, which may be 10 pip, and I will move just up. So I will move my stop loss every day as going forward based on the percentage of the ATAR. Okay. How to decide it to stop loss to be there? Well, that's what I was telling you. We using ATAR. Average true range means the volatility of that particular currency. If I am buying here, so the rule is that whatever is this value, which is 0.56, we don't consider the last one, is a fractional number. Whatever the number here is 0.56, it's mean a 56. 56 divided by 3 or divided by 2 or divided by 4, whatever is your preference. You want to do 30% of this 56 or you want to do a 50% of this 56. If I'm doing a 50%, then whatever the nearest support is this trend line. So 50 means 25 pip below this trend line. Or if I do about 25%, then the 12 pips below this trend line. So trend line is touching here. From here, I will measure my distance with this cross here and see where it's coming at the 12. This is where it's coming to 12, and I put that will be my 113.350 is my stop loss. That's how I do the calculation, and that's helped me to avoid those unnecessary stop losses based on due to the market volatility or the currency pairs volatility. Okay. Right. So I think Nasir actually asked this question yesterday. Is it help you, Nasir? We're going to go through a few currency pairs, and I will let you guys decide. Don't worry about the signals. it's giving you buy signal or sell signal. We just say we are going long or we're going short, and you need to tell me what is your thoughts about the stop loss. This stop loss is very, very important. So I want everybody to make sure like they actually get in their brain think that stop loss. Euro USD, define the stop loss.
Sir, just one question. Value of 8R is very different for different times. So which one we should be choosing?
Whichever time frame you are working, that's the 8R will be using it. If you are on the 4-hour chart, that's the 4-hour 8R. Right, so let's say we are going to short on this currency pair. What is our stop loss? Who want to do it? Anyone? Let me, if I can pick someone.
For this,
Yep. Go ahead.
is it really have to be 8R value, or can we do based on support and resistance, because that looks much clear in this particular chart?
No, I'm just asking you about the stop loss. So we are going to short on this currency, and now you need to tell me your stop loss. That's the only thing I want, nothing else.
I will put a stop loss at resistance.
Sorry, can you just type in? Okay, so he says your support level is 10558. I will put stop loss as resistance. Yes. So let me make sure what you are talking. So you're talking about right up here and up here. Yep. Okay. 1.06. Okay. All right. Is anybody else can tell me where the stop loss should be? Shahid Mansoor says 106536. 106536. 105. Okay, no. Yeah, what is the 50% of it? 33 point. Out of 33 is 12, is 10, 15, right? 16 pip. No, you don't calculate that way. Yeah, 17 pip. Okay. So where is the 17 pip you're gonna put? Okay, yes, you're right. So stop loss will be at resistance and 106686. So around here. Yep, that's right. So your stop loss will be somewhere around here. Is it too close? How many pip is it? 17 pip. And the volatility is 33 pips. So I think that's good enough. If you look the same stop loss in the other time frame, you will see you got much better picture. So that's the difference you can see up here. And here your 8R is actually 19. So what is 8R 19? That's coming more closer up here. More than 15 pip is good strategy. Yeah, so what you said, the 15 pip is good strategy or not. The problem with the 15 pip, it is an static type of the stop loss. And the problem I found with this one, if the currency is highly volatile, then it will kick you out very quickly from the market. If some of the currencies are not volatile enough, then it will accumulate your losses for longer. So the question here is we want to cater for both kind of currencies. That's why I use the 8R based system. 8R actually measures the volatility of the market. And based on this volatility, I can define my stop loss. If you want to use the entire 8R, like if it's got 33 pips, you want to use 33 pips, you can use 33 pips, it doesn't matter. But you have to, but that's stop loss needs to be cater for the both market, the volatile market and non-volatile market. That's the point. So let's see another one or two more pairs, and then we move to the different somewhere else. If 8R is giving 15 or 16 pip, then what? If 8R is giving 15 or 16, just use whatever the 8R is telling you. It's up to you. You can use the entire 8R, or you can use the lower than that. So if you got a 15 pip, then 15 pip means that's the 7 pip your stop loss. Yes, it was above the resistance. The reason why, because you were doing a short on that trade. You were not buying long, you were shorting. So on this currency pair, we are long. Where will be, we already done this one, hang on. So we go to Australian Swiss franc. Right, on this one, where will be our stop loss? We are going to short on this pair again. So we are shorting. And it is a 1 hour chart. Normally what's happened, that's if you don't see those 2 digits, you will only see the last 3 digits in the Japanese yen pair, but all other pair you will see those 4 digits. So it means this 0.00. So right now 0.00124. So last point we actually discard. So it's a 12 pip 8R on this one. It's the same thing. It's a 0.33, 0.0033 is the same thing. It's nothing different. So we just consider it based on the pip, whatever the last value, and that's our pip value. Okay, so back to this one. What is the stop loss? It is currently at the resistance level. Yes, I know. And that's why I say we will short on this pair. Six pip on top. Yep, you're right. 6 pip on top. Okay, so Australian USD, this is the last one, then we will move. Right, what is the stop loss on this? Anybody? Okay, so we got few answers. We got 6 picks. It is very volatile, hard to define the resistance level. How about now? Can you check? Can you see now? $12 pips. So the stop loss, if you are buying, the stop loss will be 6 pip here, somewhere around here. That will be your stop loss. Trend is looking upwards, yes. So we buy, and that's why we're going to stop loss it below. Okay. All right. So I think everybody got the idea of the stop loss. Profit target. There are many ways to define your profit targets. Yep, that's right. Again, the same thing, you can use your 8-hour calculation, or another way to use it, whatever your stop loss you have defined, you just times 2 or times 3, and that will be your take profit. Okay. If the pair you are working, it's on the daily chart, or it's on the daily time frame, or it's on the weekly time frame, then you check your 8-hour every day and move your stop loss accordingly. Same time, you move your take profit also as you move your stop losses. So that's a manual process. I don't use trailing stop, because the trailing stop only give you the static figures like 10%, or it's not 10%, like 10 pip or 5 pip or whatever. So for example, if you have an order, don't know, it will let you know. Take profit. So you got here, I haven't got any order open, so I can't see it, the take profit. So, but the trailing stop loss. But the trailing stop loss is basically, they will let you know let you do it about 5 pip, 10 pip, 25 pips, like that. So it's not based on the 8-hour. So that's why I don't use it. I just use my manual process. Okay, so the risk to reward is very, very important. For example, if you got 1 to 2 of your risk and reward ratio, and if your stop loss is 6 pip, then your profit target should be 12 pip. And you see this nearest resistance is hitting before the 12 pip, it means you are not going to reach your take profit target. So that's not a valid trade. The only way you can do this one, either you reduce your risk to reward ratio to 1 to 1, or you find another trade. Well, I don't know how to do this one. The question is asking, can you calculate the stop loss based on 8-hour and feed the value of the static in the system? I don't know. I have to check that. I don't think so they allow you that. And besides that, your 8-hour will change every day. So today the 8-hour is 15 points. Tomorrow it will be 10 points. Okay. So I was telling that if you got your 6 pip stop loss of the 6 pip, and your take profits come with the 12 pip, and you see the nearest resistance is before 12, reaching the 12 pips, and it is very strong, then you knew that you're not going to achieve your target of the take profit. What you can do in this scenario, that you go to the minimum risk to reward ratio, which is 1 to 1. It means you will take your profit at the 6 pip, or what you're going to do, that's you're going to actually move your stop loss to the 6 pip, And if the trade is out, it's out. If not, then you let it run as it goes. So you lock your profit at this 6 pip or 12 pip, whatever you prefer. Okay, this one I need to actually change a little bit this slide. So it's kind of is telling you the risk to reward ratio. If you have a 25 trades per week, 16 are losing trade with $100 is equal to 1600. Your winning trades with must be at least 1 to 2 risk to reward. It's been 1800. 1800 gain on each of those. So $200 per week gain. 16 minus 18, $200 week per week gain. Your 9 winning trade with the 1 to 3 risk reward ratio, it will give you $1,100 per week gain. So that's why I say it's very, very important. That's make sure you have, because if you're gonna have more losing trade than the winning trade, then your risk to reward ratio should be higher. So you can compensate your losing trade with the winning ratio. If your winning trades are more than your losing trade, then that's a good sign. But if you are losing more and gaining less trade, then you make sure your risk to reward ratio is much, much higher than at least 1 to 2 or 1 to 3. So you can compensate for the losing trade end of the week. Now we go up here. What time is now? It's more than 1 hour, isn't it? So the time is 11:46. I want to go with the MetaTrader setup, and after that, I will start talking about the strategies. And then, so we want to go for the break, lunch break now, or you want to do it later? Because MetaTrader will take at least half an hour. Okay. So it looks like nobody wanted to go for the break. Right. So we will continue.
Keep going, Shanghai.
Yes. Okay, so we continue for another 15 minutes or 10 minutes. Then we will go for the break for 1 hour. We come back around 1 o'clock, and then we start with the MetaTrader 4 setup. And then right after that, we will go on the strategies and a little bit more on the price action. So for those 10 minutes, what we got right now, what I want to do, I want to ask you guys a question, very, very basic one. That, do you understand the market cycle? Do you know when to enter into the trade? Do you understand your bearish or bullish reversal signals? Do you understand your stop loss and take profits? And do you know that's how much money you're going to risk at any single time? If anybody is not clear on any of those, just let me know and I will go that section very, very quickly. So we are on the same page when we start on the strategies. Market cycle is still confused with that, if you can. Okay, so 3 people, they looking for the market stop loss. Okay, so Shahid Mansoor is asking, can you go with the stop loss on a stop limit? What do you mean stop limit? You mean stop buy and buy limit and stop limit, or limit buy, or what do you mean? Okay, let me go through the market cycle first, right? Okay, so market cycle is so market cycle is, let's say I'll pick up a currency pair here, which is very, very clear, USD JPY. And this is the currency pair, which I will show you the market cycle, right? Now, here what you can see is the market is actually bouncing back. So, but before I do, I just make it a little bit smaller. It's too much. Okay, so that's enough, right? So these are the market cycles. The way I define the market cycle is the following. Okay. The prices are starting from this point. They're going up and then they're coming down. When they reach their peak, where they start and when they reach their peak, this one is my phase one of the market cycle, right? So this one from all the way from here up to here, that's my phase one. When the prices come down from this point and touches back to my resist support or near the support, that's my phase two. So this entire thing is called market cycle or the price cycle. What I normally say is that when you're going to put your order, you actually define your market cycle into the 5 sections: 1, 2, 3, 4, 5. You buy only in this place. You don't buy here, you don't buy here, you don't buy here. If you miss out this point, you wait for the phase 2 to complete and let the next cycle start. When the next cycle starts, then on the phase 1, you put your order here or here. It will take you all the way up to the top. Then the prices will come down. That's now complete another market cycle. That's the third market cycle. Phase 1, phase 2. Phase 1, phase 2. Phase 1, phase 2. Phase 1, phase 2, phase 1, phase 2. These are not like a kind of the static kind of the line you can draw in a sand or something and that's it. They are kind of a very, very a zone, I would say. So it's kind of a zone. It's quite loose, but you can see quite easily that's the market actually going into the cycle. The indicator of the phase 1 from the last, this indicator is not known at the time of the entry. The cycle length is not known at the time of the entry. Okay, what's happened here? Okay, so put it that way. What we are trying to do here, we are not trying to define black and white rules, right? We don't know the next market rules or the next market move. What we are trying to do here is we're trying to minimize our losses, right? Yes, I know that we don't know what's the next market move is going to be, but there are three things which we don't know, right? We are on the phase 2. We don't know that the price will continue to go down or it will reverse back. We don't know yet. To know this one, we need to wait for the next market cycle. In the next market cycle, in the phase 1, we will enter. If this particular phase is very, very short-lived, we make very small profit because we don't know what's going to happen next and we exit out of the market. If the next market cycle, if you actually enter on this one and you anticipate, yeah, it's touching down and it's coming up and up and up and up again, and if you enter and it continues to go down, is this one is better or to wait for the next market cycle is a better strategy? The size of the cycle, it doesn't matter, and I don't care about that one. What I care, the first thing is to preserve my capital. I don't want to lose. If I don't want to lose, then I don't want to go into the wrong cycle. This one is very, very small, right? I can see it's very small here, but I don't want to enter in this place because it's going up and up and up, and I can see, no, it's not. It is still considered the red and is still considered it's closing below the top with this one. So the close of this bar is below this, close of this bar is below this, close of this bar is below this. So I still consider this one as a phase 2 of this market cycle. I will wait when the prices is close above of the previous bar, and it's a green, and that's why it will be a green, and that will actually confirm me that yes, the price is actually moving up. I will not put my trade on this bar either. I will wait for the confirmation of this bar. So my entry will be around that mark up here somewhere on the next bar. So let's say the price is coming down, it touches up here, and then it's reverse. I see this bar is the next phase is starting, and next cycle is starting, but I want confirmation. The only way I will have a confirmation is this bar is starting above this. When this happens, I will put my entry on the top of the last bar. When I put my entry on the top of the last bar, it means that I will enter only if the prices move above of this point. If prices move below this point, then I'm not in the market. So the reason why I wait for this confirmation, because this particular indicator, maybe it's just one-off indicator, and it can indicate that yes, it's just one bar, and then prices can start coming down. So if I put my entry here on this bar, I am safe. Okay, so that's the market cycle. Now the question of Shahid Mansoor is stop loss and stop limit. What do you mean by stop loss and stop limit? You need to explain this one to me first.
Like when we decide based on the ATR, like, okay, this is my stop limit, I'm gonna stop it here. Like, okay, this is the limit where I'm gonna buy it. Suppose if I'm buying a currency, this is the limit. Okay, from the, if it touch here, I'm gonna buy it.
Yeah, that's your stop. Your buy stop.
Yep.
So that's the buy stop. Okay. So what you are asking, there are four things. It might getting confuse you. Is in the show. So if I add insert a slide here, so there are one thing. Okay. So stop buy, stop sell, and stop loss, right? These two, stop buy and stop sell, they are your in the order entry. That's you want to hit the price, you want to buy when the price goes above a particular price. If you go back here, we discussed this one very, very early. So buy stop is, this is your current price, right? And you are not sure that the prices will go up or prices will go down. But your anticipation is that the prices will go up. You want confirmation. So you put your stop loss, you put your buy order somewhere around here and say if the prices hit this level, then I'm in, and then prices move up, right? So that's what I think. This is what they stop. So let's say, for example, this one, prices when hit here, I'm in, and the prices will continue. So that's you call the buy stop. What is buy limit is this prices will go down and then come back. Then I will enter into the market. Then prices will go back to the current price and then will go up, right? The problem with this strategy is that if the current prices is going down, touching the support and then coming back up here, and if you have put your order, buy order here, buy limit here at this point, so you enter order around when the price is this, but you're not, this is the market order and that's your buy limit order. The problem is that when you enter on this place up here and the prices goes down, maybe it can continue go down touching your support. And then in this case, your order is already executed and you start getting the losses. So buy stop will actually a kind of a confirmation order that if the price is moving in my direction, then I will buy here. The buy limit is a kind of an aggressive strategy. That's I want to actually get a little bit more discount on my prices. I know that the move will go up, but I want a little bit more discount on the prices. So he will actually put the buy limit and say only place I will buy if it's reached here, and then the prices will move up. If it doesn't move up, then he will have that much loss wherever it can exit. That's your buy stop and that's your buy limit. The stop loss is we define based on the ATAR. That's if I'm entering the price, if I'm entering here, the support are here, then ATAR value is 12 pips. So my stop loss here, and this is a 12 pip. This one is a 12 pip. So that's my stop loss. It means that if the price, for whatever reason, after touching my buy stop, if the price continues to come down, it has to come down right up here before I can be exit out of the market. If the prices come down here and then move back, then I'm still safe. If it goes this way, that way, then I'm making the money. But if it's going that way, for example, if you put your stop loss somewhere around here, so you will be out of the market very quickly. So you are out, you lost, and now the price is moving up. So using the ATAR just below the support, number of the pip, whatever based on ATAR, is actually give you some kind of safety net. And this safety net is based on ATAR because it's a volatility base. ATAR will actually tell you what currency is volatility in last 14 days. And based on that, you can just simply define it. Okay, so does it ever happen that you want to sell at a stop loss, but order does not execute as nobody is buying it? The one of the good thing about the Forex market is very, very liquid. I hardly see that your order is not filled. It's a $5.3 trillion a day, so its market is very huge. You will get filled. Right. So if there is no other question, then what we will do is we'll go for a break. It's I think it's 12:02, so we come back at 1 o'clock, and then we go for the MetaTrader 4 setup. After that, we will go on some of the strategies which I normally recommend. It will be at least 3 strategies. And we will do some practice based on the 3 strategies. And the last thing we'll do some outlook for the market for the next week. Okay, so we all back at 1 o'clock.